Today we're going to talk about weekly versus monthly options. Now, there's probably more that goes into it than what I've shared here. Here's the basics, right, between the difference. And we can, of course, pull up the option chain and look at that in comparison to symbols that are more liquid, to those that aren't as liquid but still have the weekly options, and kind of talk about some of those differences within those two expirations. Hey, Pat Tack, great to see you. Good morning to you. So let's go ahead and we'll get started. I don't think we'll spend very long on this. So of course, if you guys want to discuss anything else, after we're done with this little educational bit, please let me know and I will be happy to go through that with y'all. Okay, let's go ahead, focus back on the topic here. Weekly versus monthly options. So there are some benefits and negatives to trading weekly option expirations versus trading the monthly option expirations. In this video, we'll go over some of those pros and cons so you can understand the difference and what expiration might benefit you, whether it's just your trading plan in general, or maybe it's for a specific trade and setup off of a certain time frame that you're looking for. So we'll start with weekly options. Weekly options are expirations that expire each week, typically on Friday at the close. Oftentimes, you find these weekly options on symbols that have more volume in their trading, right? If they're a bit more of a popular symbol, oftentimes you'll see those correspond with weekly options as well as the monthly. One of the main pros to weekly options is that they have better time decay because of the potential shorter time frame. Now, of course, as we know on SPX, right? SPX even has Monday, Wednesday, Friday expirations for that very short time frame. Then, of course, we have things like Apple and Google and Amazon that have the weekly expirations, or Tesla. So you can just get a week out rather than having to maybe go 3 weeks out for the monthly, which would technically be the next monthly expiration, and still take a trade based off a shorter time frame. This can allow you to put on trades based off of, like I just mentioned, a shorter time frame, so maybe like an hourly chart or something like that, or a smaller intraday chart, and be able to, based off this time frame, see a move and lock in the profit more quickly. Right? So if it's something like a credit spread, that theta decay is definitely going to work more quickly than on a monthly option. If it's a long debit vertical spread, you should see that intrinsic value gain in the spread if it's going in the money a lot more quickly than a monthly option further out in time. Of course, depending on a long call or put, if the move happens quickly, you could get a very nice profit there. But of course, right, long calls and puts aren't really the best with time decay. So keep that in mind, right? It depends kind of the strategy that you're going with to determine whether or not you want a weekly or monthly option. And of course, right, the time frame that you're looking for the move to occur in. On the opposite end, weekly options are typically less liquid than the monthly expiration. Oftentimes, you don't see as much volume and open interest on the weekly options when you compare it to the monthly expirations options on that chain. So because of that, you can also end up seeing the bid and ask be a bit wider compared to the monthly time frame, which means you might have to pay a little bit more. It might be more expensive to jump into it because you're having to go closer to the ask to buy in or closer to the bid to sell out. So all of those things, right, are kind of a downside on weekly options. We've certainly seen it before where we're looking to go out roughly 30 days on a long call, right? Maybe that ends up being a weekly option. So we just take a look at it and there's zero open interest there. But when we go out an extra week or two to the monthly, even though it does cost a little bit more because we're going further out in time, it certainly has that open interest and liquidity in it to be able to jump in and out a lot easier than if we jumped into the weekly option, right? So now let's talk about monthly options. Monthly options are available on every symbol that trades options, right? So if a symbol trades options, it's going to have a monthly option chain, right? It's going to have monthly options. So they're everywhere. Monthly options that you will also find go further out in time than weekly options and can allow for leap trades. So you don't typically see a weekly option expiration date out a year, right? It's usually they'll get added as you get closer to the current date. They'll add those weekly options in. The monthly options, though, can go out sometimes even several years out in time to allow for leap style trades to occur. And leaps, of course, are ways that you can buy in to a symbol without necessarily buying in the shares themselves. So usually when you get a long call for a leap, for example, it's like buying the shares because you're really anticipating long term that the price is going to move up. You're getting out that far in time because one, you want to hold on to it for a while, and two, typically you don't want that theta decay to hurt you, right? So you give yourself plenty of time to allow whatever move you're looking for to occur. Typically, it's off of a longer chart pattern, like a weekly or monthly time frame that you would go out that far. And right, it can still be less expensive than buying the shares themselves, depending on the symbol. So the monthly options give you that flexibility to do that. Monthly options are also typically have stronger volume and open interest, and of course, in turn, are more liquid than the weekly options. Right? We just kind of talked about that. How typically, when you go to a monthly time frame, that open interest, that volume of those shares being traded that day, will end up spiking up a bit more compared to maybe a weekly time frame before or after that monthly one. With their expirations being more liquid, it oftentimes means the bid and ask spreads are also more narrow, right? So because there's more liquidity, because there's more people jumping in and out of it, that usually narrows down the bid and ask. And so it allows you to get in closer at the mark, right? Or you don't usually need as much movement within the underlying price for your option strike to start to show profitability. The con to monthly options is if you're looking for a quick move based on the shorter time, you may not get as strong of a profit as you would on the weekly option expiration. And oftentimes, right, when we've looked at some trades in the main room, we pulled up our charts, we see a nice setup occurring. To me, it looks great for a credit spread. And then I jump over to the option chain. And then all of a sudden, I find that there are only monthly expirations. And it's something like this week where the monthly expiration is expiring, like last week it was expiring today. And then all of a sudden, the new monthly expiration is 21 days out. Well, if I go with, that week's, maybe that expires in a day or two monthly expiration, I'm going to get no premium for the trade. And if I go 21 days out, if it's a move I'm expecting to occur quickly, then I'm probably not going to get that much of a profit, if any, because there's going to be so much theta left in the trade, right? So monthly options are less flexible on giving you that profit potential based on a shorter time frame, especially depending on what kind of trade you're looking at. That would be true, for butterflies typically as well, or iron condors. Anything that benefits from that theta decay sum is going to, be a little bit harder on a monthly option, especially when you have a few weeks out until that expiration. If it's a next week monthly expiration, then yeah, by all means, it's going to work a little bit better. But if it's further out in time, then that's when the weekly expirations become beneficial, because you can still get a close dated expiration and take advantage of that trade and signal. And because, of course, you might be going further out in time, the trade itself could also hold more risk, right? It might cost more capital to jump into it while you're trying to wait for the move to occur. So as I just mentioned, of course, this depends on the time left on the trade, the time until that expiration occurs. So keep that in mind. But those are some of the benefits and cons to both the weekly versus the monthly expiration. So let's go ahead and pull up the option chain here, and we can take a look at some of those examples. Now, in something like SPX, right, in SPX here, as I mentioned, we have Monday, Wednesday, Friday expirations. Here's an end of month expiration that XPS has. It almost seems like any excuse for them to put in an expiration, they will do so. Here's a quarterly expiration. To know when it's a monthly expiration on Tastyworks, they will put AM, right? So monthly expirations will typically, if it's something like an index, will typically expire at the opening price. So settlement, the last day to trade it will be Friday going into the close. On Friday's open, whatever that price is, whatever that settlement is at the open, that will be where the monthly expiration expires. So if you want to trade through Friday on something like SPX, that's technically on the monthly day of expiration, like for example, May 15th, then you want to make sure to go with the W one. That will be the weekly, where it goes into Friday. Now, that used to also be the case for a lot of stock symbols as well. They used to have it to where it settled on Friday's opening price. Now they've made it for a lot of symbols where it will trade through Friday's close, right? So with Amazon, for example, I know this one will trade through the close on Friday. So it gives you that extra day and benefit on their monthly option, which is nice. If you're concerned about when a trade is going to expire, just confirm with the brokerage platform what day that's going to be. And Lee, it depends on the volume and volatility typically, right? If it's a more popular symbol like Amazon and everyone wants to pile into it and trade it, typically speaking, it will have those weekly expirations to give you that benefit and flexibility. That's why you still see on stuff like Beyond, it have weekly expirations, even though it's still so new. And that's because there's a lot of interest in people jumping into Beyond to trade it. Whereas if it's something like BJ, right? If it's something like BJ's wholesale clubs where you're like, that's one, priced pretty small, and two, I'm pretty sure not a lot of people have heard of this symbol or trading it, right? It's not as liquid. Then you have the monthly expirations. But notice how they still go out in time, right? This one, you can get a leap into January 2022. Now, notice how some of the monthly expirations are not there, right? So as we get closer to June, then we'll have the July monthly expiration pop up probably. Then August, as we get closer to that, the September and October ones will pop up, December. So, keep that in mind, right? You still will see sometimes those expirations reappear as we get closer to those months. Just like on the weekly expirations, right? We don't have weekly expirations all the way out into January or February, but we have them out to the first week of June. And as each week goes by, those newer weekly expirations will start to pop up. So let's look at something like Amazon. Now, this will still have a lot of open interest, especially because earnings is about to happen within the weekly expirations. But here's a great example of, here's the open interest, right? We still have some high open interest at the money or by those psychological numbers. But then it kind of can drop off. For example, the 2435 call only has about 16 open interest on the call side and 0 open interest on the put side. The volume, which are options open and closed within today's trading so far, you can see here, still excellent volume around the 2400, very low volume around that 2435 strike, right? Not a lot of people opening and closing contracts there. When we go to the monthly expiration on Amazon, monthly expiration, you can see this is picked up a lot more. The 2435 isn't there, but you can see, right, you don't see any where it's a 0 for the monthly, right? All these strikes have some sort of open interest in it. And for volume, pretty even on the volume. I'd say maybe a little bit more. As we get closer to the monthly expiration, you do typically see this pick up a little bit. So, and Lee, it depends, of course, on what your trading plan is, right? So if I'm looking at, let's go and just keep working off Amazon here. Let's pull this up on the chart. So if I'm looking at Amazon and I'm looking at maybe a today or tomorrow, a very short-term expiration, let's say earnings isn't happening, for example, just for this scenario. And let's say I wanted something based off a short time frame. I think Amazon's going to continue to consolidate around 2400 today, right? We've kind of seen it stall here. I think next week is when we might get a second pop and run into earnings, especially if we make a bullish divergent bar. But right now it's kind of staying narrow. Today's trading day has been relatively flat. So I want to look at a short-term trade at 2400 for today. Here's an iron setup. It's about a 14, we'll just keep math simple, a 1450 cost basis, a 550 risk. So not a bad risk versus reward. Now, as you can see here, the theta decay is really going to benefit me because it's a same day expiration. So all of this, will either settling partially in the money and hold some value, or it will be out of the money on the strikes and expire worthless. Ideally, of course, on an iron fly, I want it to stay around 2,400. So this premium that's tied up within this trade will start to decay away, right? Because the only strike that's at or near the money is 2,400. So all the value will start to decay. And in turn, I can close this out for less than 50 that way. Now, let's say I wanted to do this, but I wanted to bring this out to the May monthly, right? Still look at the same 20-point spread. Here you can see it's giving me roughly a $20 credit, right? Basically zero risk on the trade. Maybe more than likely I'd pay probably about $1, maybe 50 cents, and I would have an excellent risk versus reward. The con to this is I'm waiting 21 days for that theta decay to work for me, right? And with Amazon, even if there wasn't earnings, Amazon's still a very volatile symbol. So this is not a strategy I would want with high volatility, right? I would want it to have lower volatility because I want it to not really move. And I want that theta decay to work in my favor off of the premium. So I would want to go with a shorter dated expiration that is less likely to move against me. If I was looking at a run into earnings trade instead, right? I like Amazon to the upside. I want to give myself time to see the signal work out. Then I might consider jumping into a long call, right? Where I do want that volume and volatility to bring it to the upside and in turn lock in a profit, right? See a strong move up. If I went with a near-term expiration, right? If we brought that, let's say, to next week's expiration, yes, it's a lot less expensive. It's only $65 here for the 2450 call, but it's a lot less time to allow the trade to work in my favor. So I need it to occur rather quickly. So if I'm going short term, it's maybe because I see, a 30-minute, an hourly, I see all these squeezes lining up on the intraday charts where I'm really anticipating it to fire sooner than later to take a quick profit. Otherwise, if I'm saying, yeah, it might take a week, it's more on the daily chart for it to work out. And on the long call, I'm giving myself ideally 30 days for it to work out. And I might go with the monthly because there's going to be a little bit more liquidity in those strikes. And yeah, they're out there. So like BJ's one, for example, that doesn't have weekly expirations. TDoc does. Okay, I can't remember which one I was thinking of earlier today. It only has monthly. Maybe it was RGEN. Yeah, RGEN, for example, we did a trade off this one. Only monthly expirations. Wish I held on to that now looking at it. But this is why, for example, right, we went out in time and went with a long call as a strategy versus something like a credit spread. Because a long call is more than likely going to benefit us a little bit more favorably in RGN, like it did, compared to a credit spread, which we might have had to hold on longer to be able to lock in a similar profit potential, or for it to just move out of the money for us to get that theta decay on the trade, right? And of course, when it's something that's not, as well known, right? It's not as popular as Amazon to trade in or Teladoc currently. It's still going to have, slightly less open interest, but that's why we don't have the weekly expirations. If we had weekly expirations, it would probably look something like this, where nobody's really trading it, right? The bid and ask is a lot wider than we'd anticipate. Here, it's about a $3.30 range between the bid and ask, where when we look at this month's expiration, which has a bit more of that liquidity, here it's only about a $3.10 range. So that's still pretty wide. But you can see what I mean there, right? Usually when there's more people trading it, that bid and ask is going to narrow a bit more in your favor. When there's less people trading it, it's usually a wider bid and ask. And because less people trade the weekly versus the monthly options, especially if people are getting into leaps and stuff, right? Sometimes those are the only options available. So that's typically why monthly expirations have more people in them, because it might be, hedge funds getting out further in time or anything like that, to where there's more of that volume and volatility within it. Whereas the weekly is great, when we're doing shorter dated trades, but is less likely to have as much volume in the trading in it. So do we have any other questions about monthly versus weekly options? I'm sure there are more things like monthly expirations typically go slightly higher into the expiration, more times than not. That's, not always the case, certainly for a more bearish market that you want to be cautious, right? But, that's one of those little rules of thumb for knowledge is monthly expirations typically see a little bit of a move higher going into that close. Um, but yeah, okay, I don't see any other questions, guys. So that's it for that video. Like I said, I thought it wouldn't take as long as some of the other ones. So are there any charts that you guys want to go over? We can certainly go over SPX here on the intraday charts too. I know FILR, right? Let's go over that one really quickly. Not much is happening in SPX, otherwise I'd say let's talk about it. I would say though, if you want to, an SPX pin for today to me still seems like a viable idea. Now it might change, right? So still keep in mind the risk that you be putting in. But if you did something like a 2800 pin again on an iron condor for a 10-point spread, it looks like the mark on that is around 850. So you'd be paying about $1.50 capital to jump into that. And just keep in mind it's a lot of trade risk, what you're willing to lose on it. I'd keep it a very small contract amount. Let's type this in properly. FLIR. Yeah, Taz, the one way you could do that, right, is if you think SPX is going to move up today, which right now I'm still a little cautious whether it's going to or not, but if you think it's going to, right, consider starting with a put credit spread, and then if it keeps stalling, you could always add on a call credit spread for today and then play it through an iron condor, right? As long as you keep the same spread width and the same expiration, then it looks good, it won't cost you any additional capital. And if anything, it increases your profit potential for the day. So you can always leg into something like that too, absolutely. And then that way, of course, if SPX just shoots to the upside, then you don't need to worry about the call spread either. So let's go back to FLIR. So let's see, and we can take a look at this on the shorter time frames. But here overall, we are getting consolidation on the daily chart. We've had a nice move up in momentum, but that move up in momentum after this bearish move has just brought us right into resistance, right? We're hanging out at the ATR trailing stop. Even these last 2 days back here where we tried to trade above it, we were not able to close above that level. We actually made a bearish divergent bar here, followed through with a lower the next day. Both of those levels still held the ATR trailing. To me, it's going to be a hard level to try and break above. It is now time. On the opposite end, we have the 10 and 30 as support. The 10 period simple is trading in between the 130 period simple. So that's overall consolidation. We have a choppiness in our breakout signal. FLIR, excuse me. I was thinking for solar in my head. FLIR is no stranger to consolidating. We can see that back here on the chart. So if anything, I would want to take this as a non-directional trade into next week. Thank you so much for joining me. I appreciate it. I hope you all have a great rest of your trading day. May the trade be with you. If I don't talk to y'all in the main room, I'm certainly excited to talk to y'all again after the weekend on Monday. So please have a safe and wonderful weekend, and I will talk with y'all then. Bye.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me over.